Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Monday, June 1st, 2020. Here are our top stories. The impact of the coronavirus pandemic on Australians, and we get reaction from trustees of the Australian Superannuation Fund. And joining me now to discuss this and a lot more is Dr. Michael Drew. He's the Chief Investment Officer for MGD Private. He's also a professor at Griffith University, and he is also a trustee of the Q Super Fund. Dr. Drew, thanks so much for joining us on the program this morning.
Good morning. Thanks so much, Jeffrey.
Yeah, it's great to see
you as well.
Yeah, we're doing great. Thanks so much for joining us on the program this morning. So let's jump right in. I thought in this first segment, we've had you on when we first launched the show about 8 months ago, and we talked about the Q Super plan. And I want to get to that in the second segment. But let's now talk about, we're in the midst of this pandemic. Let's talk about how it's impacted Australians, their ability to save, and also probably most importantly, their health. So what can you tell us? What's going on there?
Yeah, well, firstly, I just want to acknowledge, I'm sure you do, Jeffrey, the first responders and all the healthcare workers that are doing such an amazing job in our community around the world. So
absolutely.
Our respect and acknowledgement to them and their service. In Australia, we have taken the virus very seriously. So our government acted very early. We closed our borders early. We've taken social distancing very, very seriously. Even within the states, borders have been closed. Mm-hmm. So the response has been actually tremendous from both sides of the political aisle in terms of cooperation. The monetary and fiscal stimulus that's been arranged has been substantial. But the really big thing has been the people of Australia who have taken this very, very seriously. And as such, we've now, as of this morning, have about 7,000 cases and only 102 deaths. Now, I say only, one death is one death too many, but sure. In a global perspective, the lockdown measures have worked particularly well on flattening the curve. I think you're about to ask me what it means for the economic price of that.
Yeah, you actually read my mind, and because you're a mind reader, I left that out of your bio. But yeah, I'm just kidding. But yes, absolutely. I wanted to ask. Here in the States, we've got 36 million people who are now unemployed. They're receiving unemployment benefits. That's probably not the true number. I was going to ask you economically, how have Australians been impacted?
Yeah, so obviously less in terms of actual numbers, but proportionally similar. So the sectors that around the world, hospitality in particular, has been really hit, and small and medium-sized businesses in particular are struggling. So the Australian government, perhaps unlike other governments around the world, our fiscal position was quite sound coming into this. And they've created a 6-month bridge, if you will, to get as much of the economy as possible over the coronavirus ravine. Mm-hmm. So some governments, as you know, are doing sort of 3 months of support. The Australian government have brought in a 6-month package. So at the moment, our financial system is handling it fairly well. We have a liquidity crisis like everyone around the world. I suppose the thing we're watching is whether that morphs into a solvency crisis for household balance sheets.
So let's also talk about savings, because we're going to talk in the second segment about Q Super and the impact to the superannuation funds, et cetera. But here in the States, as you know, because you travel here and advise on for many organizations here in the States, we have a savings problem. We have a savings gap. We have a critical savings gap, and it's only been amplified. First of all, people are thinking only about, how do I keep my family fed? How do I keep them under a roof? How do I do the things I need to do? So they're not even thinking about long-term savings. But that long-term, this has a drastic impact on how people can and will save, especially if they're lacking a job. What's been the impact in Australia, generally speaking?
Yeah, this one's different, Jeffrey. Unlike sort of other crises where you had some sort of build-up in a sector like housing, mm-hmm. banking, or whatever it might be. This time, as you know, this is a demand shock that's affected very different sectors of the economy. So we've had data coming through on the professions being highly impacted this time. Barristers, surgeons. So we've cancelled much of elective surgery in the country to make sure hospitals have been free to treat pandemic cases. But that's meant elective surgery is basically being grounded to a halt. It's starting again. But interestingly, this time, we tend to think of savings gaps for those in the lower income stratas, but we're actually seeing this in the higher income stratas. So the one that's really caught me a little bit off guard this time is just how basic personal balance sheet thinking is not in much of society. So we've been working with folks not just on, typically you think about financial freedom, but financial resilience has been really shown to be a key weakness for personal balance sheets, regardless of the income level. And I think many academic economists and policymakers, this is a really big insight for the way we think about financial literacy, we think about personal balance sheet and financial resilience. And we tend to sort of go to, our default seems to be for those who are in the lower income levels. Yeah. We're seeing this across the income strata. So I wonder, Jeffrey, if we're not at some point having a conversation about how we think clearly about managing that financial resilience, and perhaps financial freedom is for another day. But that's something that's really shone a light here, is the structural weakness in the way personal balance sheets are formed.
Yeah, I think you're absolutely right. I mean, I think people, first of all, we knew going into the crisis that people didn't have emergency savings. They didn't even have $400 here in the States. I'm sure it's something very similar. And again, it's not necessarily just people in the lower income strata, as you would expect. It's people all over the income gap, or all over all incomes, that they don't have enough money. I think you're absolutely right. Outside of the pandemic. So number one, we want to get this solved. We want to get the vaccine. We want to make sure that people are accounted for, taken care of, especially the elderly. That's number one. But number two, there really is a significant opportunity here on the education front. If you're not awakened to the fact that you need to figure out how you're going to put money away and save, minimize your spending, do other budgetary concerns, regardless of how much you make, you really need to understand that it is an important thing to do. And I have to think that, Michael, you would agree. And also, this is the case in Australia or Europe or the UK, all over the globe.
Yeah, and professions that have never been really affected by downturns, as I said, barristers, orthopedic surgeons, pilots. These are, jobs which traditionally have some, resilience to economic cycles, have been shown that the enduring questions of good personal balance sheet management, separating liquidity need from sort of financial freedom. And I think as an advice industry, whether you're working with robo through to family office or large pension plans, this is the big learning for me on this is liquidity need. We need to really think and help people use that behavioural finance to help them frame risks, and in our lingo use sort of liability matching techniques. But we need to make that in a human, a non-economist way. It needs to be in a human way, and unfortunately, many people are living this liquidity, and that's perhaps linking back to my earlier comments. The thing that perhaps is keeping me awake at night is when or if, hopefully it doesn't, this turns from a liquidity crisis to a solvency. That's what would make me really nervous.
Let's play it forward. Let's say that across the globe, we are able to tamp down this virus. We have a vaccine. People go back to work. Are you expecting, I want you to put in your economic hat now, do you think that people will now take the lessons, just like we learned the lessons from the Great Depression, 2008, that they will take the lessons and they won't spend as much, right? I mean, there is an opportunity here where people could maybe not spend and buy as many goods because their frame of reference is now shaped by this. I mean, is that a realistic expectation, or am I losing it?
I think it's realistic in the short term until equity markets start delivering double-digit returns again, and those things will all be in the past. Yeah, look, I think you're right. And I think the way we do that is, we've talked a lot about a robo advice. I think now is its time. That, helping people solve particular personal balance sheet issues at a very low cost. I think I see that as a really important part of this conversation going forward. And I think at an organisational level, wellness, broadly defined, that includes financial wellness, and all the research shows us that many mental health and other issues are linked to financial stresses. So I think organisations are really going to embrace a more holistic view of wellness, which leads into your area of expertise, which is thinking about the whole personal balance sheet, where the retirement savings fit into that, and thinking through everything from short-term liabilities. So yes, I'm optimistic that now we will see, even if it's done via wellness programs or robo or nudge, that will become more in the mainstream. I think the financial literacy people are about to have their day as well, that there'll be much more emphasis on that going forward. The only other one I'd sort of flag is, and maybe this is a bridge to the second part of our conversation, generating retirement income with forward returns as they are is going to be very, very difficult. So putting my economist hat on, as you know, there's no magic pudding. People have to lower their expectations dramatically, or you get perhaps a negative real rate of return for the next 4 or 5 years. Now, if you have saved hard and really put a big amount of money away, $1 million, $2 million, which is a very large sum of money, which many people won't get. But you and I both know on forward-looking returns, particularly if you want that in sort of a risk-free or very low volatile environment, that doesn't translate well into a sustainable retirement income stream.
Yeah, absolutely. Well, Michael, great segue, and we're going to tease it out because when we come back, we're going to talk to Dr. Drew about retirement income and also the impact to he's a trustee on the Q Super, what the impact has been to he and his colleagues as trustees. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Dr. Michael Drew, a trustee with the Q Super Fund, a superannuation fund in Australia. Dr. Drew, thanks so much for sticking around this morning.
Thank you.
Well, it's great chatting with you, and obviously Australians, as well as many people around the globe, impacted financially. Let's shift gears now. Let's talk about Q Super. You're a trustee on the Q Super Group. Give us the feedback that you and your fellow trustees, I mean, you're responsible, you have a fiduciary responsibility, at least as I understand it, to act on the best interest of beneficiaries in these funds. And people often hold up the Australian system as a blueprint for how many around the globe should formulate their own retirement plans. But how have you all responded? What has been the response there to managing these big pools of assets?
So this has been an extraordinary, and we use that word a lot, unprecedented and extraordinary, but it has been for us here in Australia. As I understand it, in the US system, you can take funds out of your 401k savings.
Yep.
In Australia, that has never, ever been allowed. So it's been a locked box. And so the Australian government, for the first time during the crisis, has allowed people under financial stress to take out 2 lots of $10,000 out of their DC or 401k equivalent in Australia, their superannuation savings, to assist with short-term financial need. So this has been a really big change for our system, and of course has meant, as investors and as fiduciaries, we've typically had a very long-run perspective on our investment program, and now we've had to meet, because of a policy change, a very short-term liability. So the system's handled that relatively well. It's been handled through the tax system, and the system's now working through that to assist households who have lost their jobs or have been temporarily suspended or have financial hardship. So in a way, the super system has acted as a buffer in this country on economic growth. So we'll see 2 lots of sort of drawings, one this financial year up to June 30 and one into the second half of next year. So that's been a very, very big change in our system. So that being said, the big challenge, as we was talking about before the break, is how do you design retirement income solutions for folks where we've got this very large rump of money now, both in the US and in Australia and in Europe, transitioning from the late accumulation phase into the retirement income phase. They'd be the things that really keep me awake at night, that cash rates and bond rates sort of grinding to not much above zero. We've watched with interest in the United States the Treasury issuing those 20-year zero coupon. So, there's big pricing signals that the bond market is telling us one thing. Equities seem to be a bit more optimistic, if I could use that expression. They seem to be pricing a V, where bonds seem to be pricing something very different. So there is a very difficult conversation we're having here about the proportion of capital draw that's required. Things that perhaps weren't popular in the past are now getting a greater hearing, like reverse mortgages, like mortality pooling. All of these things that perhaps were a bit sort of thought bubbles almost, or interesting, well, maybe we'll think about that, seem to be coming more into the mainstream agenda.
So, and included in that, I'm assuming, would be things like annuities or non-guaranteed types of annuity-like products. Do you think, Michael, tontines make their comeback?
Yeah, that's being debated. Absolutely.
Is it really?
And it's no, I mean, not in the perhaps not in the British realm of style, but some of those design principles regarding mortality pooling are part of the conversation. The challenge, I think, is and this is something I think that is the transition from sort of an academic sort of framework to implementation for millions of people. The idea that this pooling is going to be incredibly important. The Australian system is really DC in nature, as you know. So well over 90% of the accounts are in defined contribution. So we really are, the fourth largest system in the world, but we really have embraced the DC framework.
Yep.
The challenge now in a post-retirement phase that without pooling, of course, is sequencing risk, path dependency, and all the things that happen during that critical transition to retirement phase. So, we've written a lot about sequencing risk post the global financial crisis. Again, this is a period where the path of returns for retirees is far more important than the average of returns. So making sure that as fiduciaries, we're looking at wealth-weighted returns, not simply time-weighted averages. So I'm sorry that's a little technical, but it's important, I think, as a fiduciary that when we're designing retirement income products, with the hedging asset muted, zero, marginally positive, we know it's really negative real rate of return. We need to think about other levers like pooling, maybe mortality credits, capital spend, and then, as you said, deferred annuities and how that interacts with the aged care system. So, a challenge that was hard before, it's harder now.
Even harder now. It seems like years ago, it's only December, we had the passage of the Secure Act. And that, before the CARES Act and all this PPP and everything that was going on with this pandemic, we really had, I think, what was a roadmap. I'm not sure exactly what the take-up rate would have been, but we at least had a roadmap to inject annuities in, because I think we're dealing with some of the same issues. We're all people, right? So we have mortality, we have all the sequencing risk, and that was kind of lay the roadmap. Anything in Australia similarly passed? I mean, not you particularly, but is the legislature, is the government thinking about something similar, watching what we're doing here in the States, or maybe not watching what we're doing in the States, putting that aside and trying to think of your own path forward?
Yeah, the big one, there's two things that are really going on in this part of the world. How do we think about taxation of these savings, both in the accumulation, transition and decumulation phase? So like the rest of the world, the Australian government, its indebtedness has grown during this period. Again, we probably had a slightly better ratio of debt to GDP than other countries around the world, but we're moving up the curve as everyone else is. So that's a question about tax reform within retirement savings and retirement income. The second one is to provide fiduciaries with some policy framework around how to provide these products in a way that are fit for purpose for the end user. So there's a great deal of work in the legislative space happening around the framing and the regulation of retirement income products. And again, a bit like the US, that's a roadmap. Different service providers have a different horse in the race. The thing that's maybe slightly different here is that because we have these very large monolithic superannuation funds that are not for profit or for member or for purpose, we really have, I think, a very clear line of sight to our member, our DC member, and we just simply want what's best for them. The problem that we have as fiduciaries at the moment is that all of the paths have some pretty clear trade-offs. Managed account schemes with equity tail risk, or annuity-like products that have very muted forward-looking returns. These are sort of, dare I say it, these are all seem to me to be sort of economics of second best. We don't have a hedging asset at 7%. We don't have a risk-free rate that could underwrite a large sum for retirees going forward. The other one, if you don't mind me adding a little twist to this, which I think is really important for both systems, is the future of, we call it aged care in Australia. I'm not sure of the US expression, but retirement living. And
long-term care.
Big debate. Long-term care. So the debate here now is we're seeing during COVID that people are preferring to age in place than go to an institution. So that's also a very big shift that's going on here, which I'm sure you're seeing in the US as well, is how do we now think about the ageing of society and their needs if they wish to live at home, and what does that mean for retirement needs and expenses going forward.
Yeah. Well, I certainly think that's going to be a big issue because we had a lot of people here. I'm not sure if you follow what's going on here. We've had a lot of people here among the elderly, people in assisted care living facilities who have passed away from this virus, and they are the hardest hit. So I think you're right. I think people are going to be rethinking that, and they're going to be thinking about also where they live. Dr. Drew, it's always a pleasure chatting with you. So great to see you, hear from you, get your insight. Best of luck to you and the people of Australia, and we'll talk to you again very soon.
Thanks, Jeffrey. I appreciate it, and thanks for all the great work you do in raising standards in the advice business.
Thank you.
Stay safe, and best to my friends and colleagues of the United States.
Thanks. And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all your news in retirement, markets, technology, personal finance, and so much more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.